In this video, I'll be showing you how to read the charts like a pro. You need to view this video to the end because I'm going to give you under 30 minutes years of knowledge from experience about market structure, smart money concepts, and the winning strategies you're going to use to excel in your forex trading. The purpose of this video is to simplify the concept of smart money market structure and how you can use it to better your trading decisions. Now, what is market structure? Market structure refers to price movements on the charts that shows underlying relationship between demands, or which are the buyers, and the sellers, or which are the suppliers, which enable traders and you to identify opportunities and to predict market behavior. All right. So there are two types of market structure. We have the bullish market structure and the bearish market structure. For a bullish market structure, as you can see here, the market is making higher highs and higher lows, higher highs, higher lows, higher highs and higher lows, this higher high, okay, and higher lows, higher high, and higher lows, and so forth. That is a bullish market structure. Okay, you don't need a trend line to tell you the market structure or the trend of a market. You just need to know if the market is making higher highs and higher lows, as you can see right here. Okay, and when the market makes higher high, it breaks structure. You have the break of structure here, break of structure here, break of structure here, break of structure. When the market breaks structure to the upside, the market is on an upward trend. So you don't need an indicator, you don't need a trend line, okay? You don't need moving averages to determine the market structure. Those are retail ideas. You just need to identify if the market is making higher highs and higher lows. If the market is making higher highs and higher lows, you have a bullish market structure. Now, on the flip side, the bearish market structure, the market is making lower highs, lower low, lower highs, lower low, lower highs, lower low, and the market breaks structure to the downside, break of structure right here to the downside, break of structure to the downside, break of structure to the downside. Now on the chart, you can see here, this is lower high and lower low, okay, lower high, lower low, lower high, and lower low, and the market breaks structure to the downside. That is a bearish market structure, okay? The market is bearish in this case, and you don't need a moving average, you don't need a trend line to determine this. Okay, this is my smart money market structure. So if you trade naked chart, okay, when you trade naked chart, you just need to understand the market structure in order to trade naked chart. You don't need any indicator, you don't need any trend line on your chart in order to be able to identify the market structure of a market. Okay, now you need to as well also understand some key concepts like the break of structure and the change of character. Most people do not understand the difference between break of structure and change of character. All right, the difference between break of structure and change of character is that the break of structure signifies a continuation in trend. All right, this is a continuation in trend. Okay, break of structure signifies a continuation in trend. It shows if you're having break of structure to the upside, it means that the market is moving to the upside. The market is bullish. And if you have break of structure to the downside, it means that the market is bearish. Like you can see here now, this is break of structure to the upside, the market creating higher highs and higher lows. All right, higher highs and higher lows. This is a bullish market structure. While if you have break of structure to the downside, it means that the market is creating lower highs and lower lows, lower highs and lower lows. It shows a continuation of trend to the downside. Okay, now but change of character signifies a break of continuation. All right, a change of character, you can see here, it signifies a change of continuation. When the market is moving on a bullish side, the market is going the bullish direction, okay, and then out, like you can see here, this is a change of character. It signifies a reversal in the market direction. Okay, a change of character, which is CHOCH for short, signifies a break of continuation to the downside. Okay, now that is for the bearish change of character. For the bullish change of character, you have if the market is making lower lows and lower highs, lower lows and lower highs. Now this is change of character. All right, change of character, and now this signifies that the market is moving, is going to change direction. These are all break of structure to the downside. Now you have your change of character right here. Now they're going to start having your break of structure to the upside. That is that's a function of change of character. Change of character signifies a change in market direction or a reversal in trend, while break of structure signifies a continuation in trend. All right, it signifies a continuation in trend. Okay, now let's move. Now you can see here on the chart, the market was creating here lower lows, lower high, here lower lows, lower high, lower lows, and now this is lower low, lower high as well. But you can see now this high, this lower high was taken out here, was taken out by this candle, by this movement, and that gave us change of character. All of these, we have change of break of structure to the downside here. This is your break of structure, break of structure, break of structure. Okay, and here this is the last break of structure before the change of character occurred. Now you start having break of structure to the upside. Market started creating higher highs. Okay, higher highs and higher low, higher highs and higher low, and continuously that way. Okay, so this is to show you that there's a difference between break of structure and change of character. You need to understand this concept, this key concept, if you must be good in market structure, in smart money concept market structure. All right, now there's also something you need to understand, which is called internal and external break of structure and change of character. Now you need to understand that the market is fractal. When we say that the market is fractal, it means that the same thing that occurs on your higher time frame is also the same thing that occurs in your lower time frame, but it occurs in a mini version. All right, the higher time, everything that occurs in your higher time frame also occurs in your lower time frame, but in a mini version. For example, now this could be your daily time frame. This could be your daily time frame or your H4 time frame. This black movement is your higher time frame. You can see the market is creating higher highs and higher lows. Okay, on a bullish trend. All right, bullish trend. Then on brown here, okay, or light red, on light red here, you can see that the market creates higher highs as well and higher lows. Okay, its own market structure. Now this light red could be your 15 minutes time frame or even your 5 minutes time frame. Okay, while the black is your higher time frame. Now you can see here that the best trades mostly occur when your higher time frame market direction aligns with your lower time frame market direction. Now what do I mean? On a higher time frame, we have a bullish market structure for higher time frame. This could be H4 time frame, okay, or even daily time frame. All right, where this market is bullish on a higher time frame, but on a lower time frame you could have bullish and bearish as well. Like here now, this is a bullish phase. All right, this is bullish phase, this is bearish phase on a lower time frame, counter this bullish trade. This is bullish on a lower time frame, this is bearish on a lower time frame, because see, you can trade the mitigations of this. In a while I'll tell you what mitigation is. You can trade these supply zones down to the downside, and you can trade demand zones up to the upside. Now when even though your counter trade here, this is a bullish market structure on a higher time frame, even though you can trade these supply zones down here to this demand zone, all right, this higher time frame demand zone, it can work. But the best trades happen when even this is a higher time frame bullish market structure, when you are trading higher time frames. Like here, you are trading this on a lower time frame. The best trades occur when your higher time frame trend aligns with your lower time frame trend. Okay, that is to say, in this market, even though on lower time frame I can take sales, like here, I can take all these sales, I can trade them down to the higher time frame demand zone. But your best trades, your best winning trades occur when you are taking buys here. Like in this case, you're taking buys on your lower time frame as it aligns with your higher time frame market direction, because your higher time frame market direction here is bullish. Okay, so if you take buy trades on a lower time frame, it has a higher probability of success because it aligns with your higher time frame trend or market structure. I hope that is clear. Now you can see here, now this is your daily time frame for Euro USD. All right, daily time frame. I want us to see this on a lower time frame. Okay, I want us to see that. So I've marked it down here. Okay, so I've shaded this. Let's see this on a lower time frame. It looks so small, but on a lower time frame it's going to be expanded to show you the market direction. All right, so on let's see on H4. This is a H4 time frame. H4 time frame right now, you can see that the market is making higher, lower high, and lower low. Okay, and there's a break of structure right here. Okay, lower high and lower low. There's a break of structure right here. There's a break of structure right here. Lower high and a lower low. Okay, there's break of structure. So let us expand this. Let's move to 30 minutes time frame to have it clear how it's going to be. So here you see that we are in a bearish trend on H4 time frame. But if you will go to the 30 minutes time frame, you're going to see that we have both bearish and bullish, because this will be a bullish phase. This movement, retracement will be bullish phase. Okay, this will be bullish phase, and while this will be bearish phase. Let us go to 30 minutes time frame. So you can see now in 30 minutes time frame, we have the market giving us this in this form. Okay, it is now clear on in the 30 minutes time frame. Okay, so as well we could trade the mitigation. You can trade the mitigation of this zone. Mitigations, you can see you can trade the mitigations of those zones. Don't worry, in a while I'm going to show you the mitigation. So that is to say that the market is fractal. That is to say that whatever happens on a higher time frame also happens on a lower time frame, but in a mini version, as I've said. Okay, now what is mitigation? Mitigation refers to price, when price comes to fulfill pending or open orders that are left by institutional traders. Okay, when I say institutional traders, I mean the big banks and the hedge funds, high capitalized traders. What we do as smart money traders is that we trade in the footprint of the big banks and the hedge funds. We may not have their size of capital, but we know when they leave a footprint, and they leave a footprint by the principle of demand and supply. Demand zone and a supply zone, we know that is a pending order left by the big banks and hedge funds, and we trade in that line. When price comes to that line, we look for entry confirmations and trade in that line. All right, so here you can see this is a demand zone, and it is called the mitigated demand zone. Okay, the mitigated demand zone means that price has come to the zone and bought from the zone. All right, here this is a demand zone, but this is an unmitigated demand zone because price is yet to come to buy from the zone. All right, the orders are still left pending, and price is yet to come to mitigate the zone. Is yet to come to fulfill the order on that zone. Here, this is a mitigated demand zone. All right, so what do we do as smart money trader? We trade the mitigations of zones. Like here on this chart, you can see this is a mitigated demand zone. This zone, price has come to this zone and bought from the zone. Here, this is an unmitigated demand zone. Price did not come to this zone. This is a potential entry. Okay, this is also a potential entry for we to trade. Okay, these are potential, but here this order has been fulfilled. Price has come to mitigate that demand zone. Now, on the flip side, for the supply zones, this supply zone has been mitigated. Price has come to sell from this zone. Okay, is mitigated. Price has come to sell from this zone. This is an unmitigated supply zone. Price yet to come to sell from this zone. So this is a potential entry, our trade entry. Here, price just came to the zone. So you just need to look for entry confirmations and sell from here. So very important. Now on the chart, you can see this zone is yet to be mitigated. Price did not come to this zone. This zone was mitigated. You can see price came to this zone and price sold from the zone. So that's the principle of mitigation and non-mitigation. All right, you need to don't trade mitigated zone. A mitigated zone is a low probability zone. Avoid trading from a zone that price has come to trade from before. Your aim should be to trade from a fresh zone. All right, zone that has not been mitigated. Okay, that is your point of interest, or your zone, the zone that you should be looking at taking trades from after entry confirmation. Trade from zones that are yet to be mitigated, that are yet to have price come to them. Trade fresh zones. If you want to see high probability of success. Okay, now I want to talk about briefly the concept of complex market structure. Now, on all the charts I've been showing you just have this is how I depicted your bullish order flow. Now you can as well have your bearish order flow in this way, but most times price may not move in this way. All right, this is just a basic depiction of the market structure, but you can see here this is a complex. This looks complex because, and sometimes this looks complex. Okay, you can see it appears complex, but then so some traders would could be confused when they see all of that. Okay, you could be confused if you don't master complex market structure. So, okay, the simplest way to understand complex market structure is to understand your swing lows and your swing highs. Let's take 2 points. For your swing high is the highest of 2 points. All right, so this is your swing high here. Okay, here, this is your swing high. All right, so once you understand your swing high here, this is your swing high, these are swing highs. All right, and your swing high is determined by the break of structure. Find out this is a break of structure here. All right, so that gave us a swing high. These two are highs, but which one was a higher? This is your swing high in this case. So here, this is your swing high as well. So once you're able to identify your swing high, you identify your swing highs and your swing lows, you can be able to a complex market structure will not seem a big deal for you. I'll go and explain more in detail to you. So once you understand your swing highs and your swing lows, you can now tell when will there, with this question you ask yourself, when will that now be a break of structure? For example, if I understand that this is my swing low here, I'm now looking for this swing low to move up, price taker from here to break the structure to the upside, to break the swing high. Now I'm expecting the market to create another swing high. If the market creates this this swing high becomes valid when the market comes right there, creates a swing low and breaks above it. All right, we are now expecting the market to form another swing high. So regardless of what happens in between, before a new high is created, is not really important. What matters is that I've identified my swing high and my swing low, and that gives me my market structure, my market direction, my break of structure, and my potential price entry. So here I'll be looking to enter from here, take this demand zone, trade this demand zone here as well, trade this demand zone from there. Here I could be looking at taking supply trades from there as well. All right, let's see the chart so we can understand clearly what I'm saying. Okay, so here, what are your swing lows and your swing highs? Okay, here these are swing highs. Those are swing highs. And these are swing lows. Okay. Those are swing lows. Okay, so and swing lows are created and swing highs are created by the concept of break of structure. So you need to understand break of structure. So ignore what happens in between. Like here, all these are, you just ignore what happens in between, like that. Okay, you ignore all of these movements here. Okay, you pay more attention to the swing highs. So once you identify the swing highs and your swing lows, and then you look at break of structure to the either the upside. Like here now, you can see break of structure to the upside. Okay, these are swing highs, break of structure to the upside. So that helps you to understand market structure. Okay, you can see here now your change of character occurred here as well. Change of character occurred right here as well, regardless that this is a complex market structure. Okay, so forget about what happens in between. Identify your swing highs, identify your swing lows, and then look for break of structure in reference to your swing highs and your swing lows. That will help you to trade complex market structure, understand complex market structure, and trade it accordingly. Okay, this is for this chart. Let's see another chart. You can see here as well. This is a bullish phase, and these are your swing highs, break of structure to the upside, swing high, break of structure to the upside, swing high, break of structure to the upside, and here these are swing lows. Okay, swing lows. So we can take trades from here. All right, you can take trades from here. Here, this was mitigated as well. So this is how to trade your complex market structure without having any problem. Okay, so if you're yet to subscribe to this YouTube channel, please do not fail to do so. Give this video a thumbs up if you are finding value from what I'm sharing. All right, that will encourage me to do more videos that will help to explain. I've got a lot to share with you that will improve your trading career from my years of experience. Okay, and if you're yet to join our free Telegram channel, do not fail to do so. The link is in the description box of this video. In there, I share free chart analysis and concepts that will help you to improve your trading. And you can trade at your own discretion. The setups and analysis that we share there every week. If you want me to train you one-on-one, mentor you one-on-one, and to help you to become better as a trader, even if you have been trading for years, I can help you to correct your deficiencies and advise you and help you on how to correct your deformities and help you to become a better trader and profitable trader. Do send me a DM. My DM contact is in our free Telegram channel, and the link to our free Telegram channel is in the description box of this video. So I want you to drop me a comment down below if you found value from this video and let me know what aspects of difficulty you are experiencing in your trading career, so I can make videos around those areas. Till I come your way next time with another useful content, do have a wonderful day ahead. Bye.